Welcome back, and congratulations for making it to Module 4. This is Lesson 1, and we're going to talk about pricing cash flowing notes to start. From Module 2, you found out that it's very important to establish a buy box, which is just another way of describing the purchase criteria. Now, the buy box lesson provided some foundational material that you'll find very useful as we dig deeper into pricing in this lesson. Now, I've gained some great insights as a note investor myself, but it was really the hundreds of loan transactions with other investors that really gave me a unique outlook on pricing. So I'm going to share that with you today. Now, to be clear, when we talk about cash flowing notes, that includes performing notes, reperforming notes, and subperforming notes. Now, the first pricing variable I'm going to cover is credit quality. Now, everybody's heard of a FICO score, but what is it? A FICO score is the type of credit score created by the Fair Isaac Corporation. And a FICO score is simply used to determine the credit risk. Now, credit quality for a borrower is important when pricing a loan because it's a great predictor, in most cases, of the future cash flow. Now, credit quality also affects the borrower's ability to refinance. And when you buy notes at a discount to the loan balance, a refi can result in a huge payoff on your note investment. Now, credit quality also affects your ability to retrade a note to another investor. Now, let's take a closer look at some credit scores and make some distinctions. Now, credit scores are typically going to range from 300 to 850. Over 620 is generally an attractive credit score for most note investors. Now, between 580 and 620 is often acceptable as long as there are some other compensating loan characteristics, such as higher equity in the property, or the borrower has a very clean pay history. A credit score under 550 tends to be a difficult score for a lot of investors to get comfortable with. Now, just a quick note on pulling credit when you're conducting due diligence. A hard pull, as opposed to a soft pull, that'll show up on a borrower's credit report as an inquiry. So it's important to know whether your vendor is offering a soft pull. I've heard stories about litigation between borrowers and note investors that stemmed from an inquiry where there was no permissible reason to pull the credit. Now, the average cost of pulling a credit, it's only about $12. But besides credit, another key factor that will drive pricing on performing loans is the note rate. The note rate, or coupon, is the interest rate stated on the mortgage note. Now, a higher rate generally translates into a higher yield for the investor. So you'll generally need to price loans with higher note rates more aggressively in order to be competitive in the market as a note buyer. So let's get a little more specific about what constitutes a high and a low rate today. Now, 6 to 8% as a note rate would tend to be pretty attractive but for most note investors. Now, 4 to 6%, probably a little more common. That's where we see a lot of note rates today. And under 4%, it tends to become a little more difficult to generate an attractive yield. Now, that is, unless you're able to buy at a very steep discount to the unpaid principal balance. Now, equity is another pricing variable. Now, under 70% loan to value, or LTV, would be considered a very strong equity protection. Now, there's a higher likelihood that the note investor will receive a full payoff with this level of equity. And the biggest reason is it's easier for the borrower to refinance if they have equity. Now, 70 to 85% loan to value would be considered very good equity protection. There's a decent chance that the note investor will receive a full payoff or near full payoff in this scenario. As you get up into 85 to 100% LTV, that should really be looked at with a little more pricing conservatism. The reason is the value could easily be inflated by 10%, meaning the loan to value is much closer to or even at 100%. Now, secondly, it's important to consider there's 8 to 10% in closing costs when you liquidate a property. And as the LTV approaches 100%, it simply becomes less likely that the note investor will realize a full repayment of the loan. Now, that's particularly when there's an event of default from the borrower. Now, the total debt to the investor is likely to exceed the value of the property in that case. On that point, let's talk about pricing underwater loans. We've just discussed how important loan to value is, or equity, in pricing notes. And if you're going to price a portfolio of loans, I'd recommend sorting the data in an Excel file by the loan to value, or LTV. It'll be very helpful. It's going to give you a clear look at which loans have equity and which don't. Now again, you're evaluating which loans have LTVs under 100 and which are over 100. The loans with equity are priced off of the unpaid principal balance. Underwater loans are priced off of the property value. It's always the lower of the two. Now, 100 to 125% loan to value can be concerning, but if there's a very clean pay history and strong credit score, that might offset some of the concern. So I wouldn't rule those loans out. However, over 125% loan to value can get a little bit more problematic, and here's why. When a loan is over 25% underwater, 125% LTV, this is generally considered the level where the borrower's psychology shifts a bit. And they can be less committed to pay the mortgage when they feel like they're always going to be underwater. And this simply means there's potentially a higher probability of default, and it should be factored into your pricing. Let's shift gears here and talk about seasoning. It's a term used to describe the age of a loan. Now, a loan is typically considered fully seasoned after a year of on-time payments. And seasoning sometimes plays a role in pricing performing notes. Reason being is investors tend to have more confidence when they see a year of history in terms of on-time payments. Now, I want to talk about a balloon payment mortgage here. That's a mortgage that doesn't fully amortize over the term of the note, and it leaves a balance due at maturity. That final payment is called a balloon payment because it's a large size. Now, balloon payment mortgages, they're more common in commercial real estate than residential real estate, but you'll still see them with residential. When pricing a loan with a near-term balloon payment, a note seller is typically going to require more aggressive pricing because the full repayment of the loan is coming due. Now, a borrower facing a balloon payment is typically either going to refinance, they're going to pay the loan off in full, or they're going to request an extension from the current lender. And in the event the lender declines that request for an extension and the borrower doesn't make that balloon payment, it's referred to as a maturity default. So let's talk about calculating yield. A discounted cash flow approach, or DCF, is a valuation method used to estimate the attractiveness of an investment opportunity. A DCF analysis uses future free cash flow projections and discounts them to arrive at a net present value, or NPV. Some performing note buyers will calculate what's called a yield to maturity, while others will take a slightly different approach and calculate what's called a cash-on-cash yield. Now, investors often assume the borrower is making 12 of 12 payments per year and doing so on time. But this isn't always the case and can result in artificially high yield and the risk of overpaying for the note. Now, this is particularly true when pricing a loan that has a spotty pay history. So the advice here is to really just spend time evaluating the likelihood of receiving a full 12 of 12 payments per year when pricing a performing note. So let's see what this actually looks like using a yield analysis tool, which is provided in the Resource Center. So if you look at this note, we purchased in Florida earlier this year, and the loan assumptions at the top will kind of set this up. The property value was much higher than the UPB, so there was considerable equity in the property. Our BPO showed $125,000 asset value, while the UPB that we were pricing it based on was only $52,000. We knew that there was a remaining term of 202 months. We knew the monthly payment was $537, and the interest rate was 10%. Now, based on 12 of 12 payments, which was consistent with what the pay history showed for the past few years, we felt comfortable that that's how we should price the loan. So what you see is various purchase price percentages on the UPB ranging from 70 at the low end to all the way up to 100% or par if we were to pay that price on the note. We then took a look at what is the yield that we need for our buy box, and that's really in the sort of mid-teen range, 14, 15%. So as we plug in the right scenario here for our buy box in a 14, 15% yield, we saw that our purchase price needed to be around 75% of the unpaid principal balance. In dollar terms, that was roughly $39,000. Now, again, as I mentioned, there are a couple of different approaches to calculating an annualized yield: the net present value, the cash on cash, and then the P&I approaches, which is simply taking the P&I payment, monthly payment, times 12, so what is that annualized, and dividing that by your purchase price, and you arrive at your yield calculation. So make sure to utilize the tool and play around with different pricing scenarios to get some comfort evaluating cash flowing notes. So we covered a lot of information in this lesson. So let's recap. Credit quality matters as a driver of pricing performing loans. High note rates tend to mean higher investment yield and thus drives higher pricing on performing loans. Equity has a strong correlation with the investor's loan payoff and also impacts the borrower's ability to refinance. The age of a loan or seasoning is another important pricing variable. And finally, investors use a variety of methods to determine investment yield on cash flowing notes. I'll see you in the next lesson.